My name is Bryan Wagner. I work in the Global Sustainable Finance Group at Morgan Stanley. I'm delighted to be here for our panel, Adopting a Client-Centric Strategy to the Economic Base of the Pyramid. Would like to thank the Columbia Social Enterprise Conference for having us. It's a really exciting panel and exciting discussion. I think you'll be impressed by the innovations that are happening in the field. I also want to thank our panelists, who each are very impressive individually, in addition to working for very impressive organizations that have been doing some amazing things in the field. In terms of the agenda of the discussion, I think we're here till 10:40, so we have about 70 minutes. I'm going to spend a couple minutes at the beginning making a couple of introductory comments, and then we're going to give each panelist 3 to 4 minutes to talk about their organization and talk about what their organization has seen or is doing around product innovation, to give you a sense of the perspective that they're coming from and the type of work they've been doing. We'll then spend 20 minutes or so having a moderated discussion amongst ourselves, and then we'll leave 15 minutes at the end for questions from the audience. So please be thinking of questions. So on the first point, in terms of some introductory comments, I think from my perspective, I think this topic is so interesting and relevant for 3 reasons. I think firstly, I think the amount of product innovation that's happening right now in the financial inclusion sector is unprecedented, and I think to some extent, if you're not embedded within it, may have been a little bit overlooked. I think you'll hear everything from new lending products, so lending products in housing, lending products in education, to the topic of savings and insurance, which is another form of savings, to the area of payments and correspondent banking. So much happening there, trying to provide low-income communities a safe way to store money and to transact. And also a lot of work going on in the area of financial capability, which is really applying a lot of the work that's been done around behavioral economics to figure out how can we help low-income people make good choices and to some extent change their behavior over time. And so I think you'll hear from each of our panelists some of the work that's going on there. The second thing I'd say is it's very easy to talk about product innovation, but it's hard to do product innovation if you don't understand the lives of your clients. And I think microfinance for a long time has struggled to really understand the day-to-day workings of clients. There's a lot of good evidence of need for loans, those loans being repaid. But I think just in the last couple of years, there's been a lot of reinvigorated efforts to understand more deeply what those clients' lives look like. There was a book written a couple of years ago called Portfolios of the Poor, which many of you in the room may have read, that looked at this in detail. But I think what's changing now is that technology is allowing us to get that information from our clients much more real time. To give an example of that, we hosted a panel a couple nights ago where there was an entrepreneur who started a business where small businesses can use SMS texting to text real time their revenues and their expenses. So and then there's a data source that captures that and can create real time income statements for small businesses. Another model that we saw where someone's looking at mobile data around top-up frequency, how frequently clients are purchasing minutes, and that becomes a way of understanding better some of the cash flows of the clients. And so I think technology is a big player in this in terms of giving us that real-time information that allows product innovation to occur on the back end. The third thing is that I think client-centric is, to some extent, a buzzword today, and I think it's not clear what that word means, and I'm guessing it means different things to different people. And as evidence of that, I spent some time yesterday Googling the definition of client-centric, so I was curious what showed up. And the first definition I found was from Investopedia, which says that client-centric is a specific approach to doing business that focuses on the customer. Client-centric businesses ensure that the customer is at the center of a business's philosophy, operations, or ideas. Those businesses believe that their clients are the only reason that they exist and use every means at their disposal to keep the client happy and satisfied. That's sort of definition 1 about client-centric. Second definition I found was from businessdictionary.com. It starts off very similarly. It says, it's a method of doing business that focuses on the client or customer. But then it goes on to say, companies that use client-centric models try to gain a greater share of a customer's business or wallet by offering a variety of services that allows them to reach different kinds of customers. Which is interesting, because that's taking that idea a step further. And it's sort of saying it's not just doing one thing really well, but it's actually trying to offer that, trying to meet multiple needs of that client. The third definition I found, which was very interesting, is from a website called cheesycorporatelingo.com. The definition of client-centric on that website was a term used when telling your client that you are more concerned with protecting yourself than working for your client's interest. And in case I didn't pick up on the sarcasm, they gave me a couple synonyms. One is CYA and the other is air cover. So I think those are 3 interesting definitions, because I think what we should discuss with the panelists is Is client-centric just understanding the needs of your customer and whatever product you provide, making sure that you do it in a way that it has its intended impact? Does client-centric mean that we are obligated to go beyond that and to understand beyond that just one product, what are the other needs, and we're obligated to try to meet those? Or thirdly, to the definition from cheesycorporatelingo.com, is this kind of much ado about nothing? Is this just a buzzword that sounds nice that we're all talking about? Has anything really changed? Was microfinance ever not client-centric? And so it'd be interesting to hear from the panelists as well to what extent they've seen things changing in the field. So with that as a backdrop, we're going to give each organization 3 to 4 minutes to talk about what they're doing, and it'd be helpful for maybe for the audience if each of you could give sort of your definition of client-centric and how that maybe fits into some of the definitions we discussed. So we're going to start with Scott.
Thank you. I was actually going to kick off with the first of 3 points was just a discussion of what exactly do we mean by client-centric or client-centricity. So I won't waste too much time talking about BRAC, but the world's largest NGO by most standards in terms of number of employees, about 100,000, based in Bangladesh, founded in Bangladesh in 1972 after the War of Liberation, now active in 11 countries and an estimated reach of 126 million people doing a whole bunch of stuff, put it that way. Microfinance is one of them. Client-centric. I would actually be really fascinated to hear from somebody in the room who advocates a non-client-centric strategy, because I have difficulty imagining what client-centric means without picturing the opposite. So if somebody were to please stand up and say, no, client-centric, that's a bad idea, that would be a really interesting discussion. But I will say this. I thought of a dinner party conversation that I had with, it was over a dinner table, and our founder, Sir Fazli Hassan Abed, was there. And one of the journalists at the table asked him, so how does it work, actually, when BRAC goes into a new country? You're the world's largest NGO, massive in Bangladesh, now active in Afghanistan, Uganda, about 11 other countries total. How does it work when you start up? And he said, well, actually, we just go out there, our field workers go out there, and we talk to people, and we ask them, you know, what do you need? What are the opportunities for improvement that exist in your daily life? And he said, you know, we talk to the women. That's really important. Don't talk to the men. Don't listen to the men. They don't know what they're talking about. They'll tell you that we need a hospital. Well, a hospital might be nice, but it's not the first thing that they need. It's more likely going to be a well for clean drinking water, access to immunizations, access to basic curative and preventative health care services, you know, oral rehydration solution for diarrhea, that type of thing. So if you want to create innovations that work, the first thing is talk to people, listen to people, and I think that, at least from BRAC's point of view, being client-centric really means being woman-centric. 90% of our clients are women, and like it or not, this is not any sort of bold statement about anything, but like it or not, women do most of the work. Sadly, if the baby's crying, they're the ones that figure out what's wrong. They tend to be the ones that, you know, prepare the food, fetch the water, etc. And this goes for microfinances as well. 90% of our microfinance clients are women. Second point I just want to touch upon briefly, because my 4 minutes are probably almost up. There is a discussion that'll probably come up about accessing microfinance institutions accessing commercial capital, commercial versus philanthropic capital. From BRAC's point of view, you know, we'll take money where it's available. In Bangladesh, out of our budget of the national Bangladesh expenditure of 642 million for BRAC, 70% of it is generated from its own activities. Now, it could be 100% self-financed. It is not, mainly for 3 reasons. One, we see the problem of poverty as urgent, and we want to spread the solutions as far and wide as we can, scale up as much as we can, which means accessing sometimes equity, actually, debt capital, commercial capital, philanthropic capital. There's a role for all of those. The second reason is that it kind of keeps us on our toes. It keeps us accountable. If we were fully self-financed, we wouldn't answer to anybody but our board. And BRAC is famous for issuing reports that are more critical of itself than most other people are of BRAC, which I think is kind of cool. And the third reason is it just allows for better sharing of knowledge. Knowledge gets out there through collaborative partnerships. And my time's probably almost up, but third thing, I think we should touch upon the importance of savings and the conversion or the transformation of microfinance institutions to microfinance deposit-taking institutions. This is a journey that many MFIs are on, and there are challenges. It's difficult. It's usually a process that lasts several years. Savings are important to the institution. In Bangladesh, 30 to 40% of the financing of microfinance comes from individual savings, so that is actually a source of commercial capital, in a sense. It's important for the savers' portfolios of the poor. I mean, when people live on $2 a day, that doesn't mean they're living on $2 a day. That means they're living on $0 one day, $0 the next day, and eventually, hopefully they get enough to get by. That requires a cushion of savings. The poor are saving already. It would help if they had an opportunity for more reliant and efficient ways to do so. I'll leave it at that and turn it over to the next speaker.
Great, thank you, Scott. And Bob?
Yeah, hello, I'm Bob Annibale. I'm sorry, I'm sitting in for one of my teams, Jorge Rubio, who was an alum here. And I established Citi Microfinance, I guess, about 6 years ago at Citigroup, and head up community development there, too. And I think that, I see all of this from a different vantage point, and one that we primarily work with institutions themselves as clients. We have about 30 years of philanthropic work in the area of microfinance. Our foundation continues to be probably one of the largest in the banks that work around financial inclusion, and all these institutions here, going on and off, all these institutions here, in one way or another, we work with. I mean, actually all of them, actually, directly. So it's interesting. And we're also present in over 100 countries. So whether it's BRAC in Bangladesh, or as BRAC expanded into East Africa and did an Africa Fund, or Grameen and a very wide family of Grameen around the world, as well as here domestically in the US, we have a history of working with all of them. And what was most interesting was watching the evolution of the sector and how the sector itself, how diverse it is. And then if you look at the focus on the client and the understanding of the client, I mean, I think what's very clear amongst all of the institutions, and those which have done very well and those which have hit challenges along their way, one is that's to be expected. I think they're doing work that is in a space that most have never done before, in financial services at least. The other is that regardless in many cases of most of them, of their ownership or the structures they operate from, they do try ultimately just to serve the client. They have a very focused view on serving a client or a community. The tools have often been challenging because they've been limited in some ways by resources, and again, mostly by resources and just by time and innovation. So there is a history of people would say, is microfinance really focused enough on what the needs of individual clients are? And I think any one of the founders of it would say they do their best to be focused on the needs of an individual, but they began by focusing on a community and on large segments. And so we've seen a great evolution in the sector amongst the different types of institutions and regions, from what was traditionally group lending to increasingly individual lending as well as that evolves, to almost micro-enterprise, small business lending. And organizations like Grameen and BRAC in Bangladesh, where they have a long history, actually have banks as well that go into whole client segments of commercial and corporate, serving all kinds of social businesses and small businesses as well. And I think that's an evolution in a matter of time and capital. I think it's a sector that grew very rapidly from a small base in most of the world. I mean, if you take out Bangladesh and Indonesia, if you pull out a few other markets like Mexico, which by far, and maybe Peru and Latin America, Colombia, you start to say the numbers really start to shrink in terms of as a percentage. India being then a place where we saw quite a boom in growth and outcome, and then a decline after one state, Andhra Pradesh, went through its tirade Reserve Bank of India, and a state versus central government battle. That political battle, which has a large dimension of being a political battle, we see happening in Bangladesh today too. And one of the things you would see is being very focused on this client segment will also bring you, and when you come above the radar and scale, is challenging to many other institutions that exist there. So as we go around the world and look, I would just say, think of microfinance, it's gone beyond just microfinance to really a wider spectrum of institutions providing access to financial services. It's not just microcredit anymore. That term is used less and less because savings is a component, remittances and transfers are a component. And for many institutions, if I think of ProMahair and I think of some of the members of all of their organizations, healthcare, accompanying programs that will give them access to health services or insurance. Organizations using their size to acquire and be able to purchase other services that they can bring to their members is something that has been a very natural evolution. So I do think the microfinance of all the sectors, while having had a limited resources to how quickly one could evolve, has been taking on the different needs. And just very quickly saying that is, we remember if we begin most things with group lending and amortizing loans, those work for certain needs. But as you get into agricultural communities and others, actually you need loans that repay all at once when you sell your crops, but you really can't even service interest during the period when you have no income. And microfinance institutions are responding to that differently. There are those that are starting to realize individuals in that group are starting businesses that have longer-term capital funding needs, even if it's small equipment or other things. And is 9 months or 12 months enough? And maybe not. Maybe it's 24. And I think that is an evolution of the sector. And as banks and others in some countries actually become providers of services, they too are going to be bringing in another range of products and challenges.
Great, thank you, Bob. So next we'll go to Katherine. Katherine, I'd ask you in particular, given that you bring the on-the-ground U.S. perspective, it'd be interesting, but from the heritage of an overseas international perspective, how is what you've seen in the U.S. extremely comparable to sort of the experience of Grameen internationally, or have you found even unique needs and products here domestically?
Thanks, Brian. So just quickly, I work for Grameen America. We've been around for about 4.5 years. Professor Yunus started Grameen America in Jackson Heights, Queens in early 2008 based on the success he had overseas. We've got just under 12,000 borrowers, about 56 million out in disbursements, and we're in 4 cities across the country. So, when we talk about focusing on clients, I think you can't talk about, when Professor Yunus started this group lending model. So I think when we think about how we're focused on our clients, it's about that group lending model. So instead of focusing on business outcomes and building business plans, it's really, the onus is now on the borrowers to vet businesses, get to know each other, and to ensure proper repayment and attendance at the weekly meetings that we run. In terms of products, the United States is different in a lot of ways, obviously, than other countries. So in the same way that other micro-lenders are focusing on savings, we're doing the same with partner banks like Citi and some others, Capital One and Wells Fargo, but we're also focusing on things like credit. So all of our borrowers are reported to experience building credit, which is not necessarily an issue in the developing world, but here at Grameen, we listen to our borrowers, and that's something that they need. We're really focused on financial inclusion. So through our weekly meetings and our regular touch points, we really get to know our borrowers pretty well. So we listen to their needs, and we try to respond in the best way that we can. I think having been around for about 4.5 years, we're going to continue to grow products and focus on the clients as we can continue to scale across the country and to grow our borrower base. But it's been a really interesting model to run here in the United States. One of the most common questions we get is it any different than it is overseas? And ultimately, we run the same model. We've got the same exact return. We're about 99% repayment rate, which is really strong and exciting. And in the same way that BRAC works, when we expand, we walk into a community and we ask, what do people need? The last thing we want to do is to go into a market where there's already a micro-lending program that's servicing the same borrowers that we're servicing. So that's our focus, is what's the need? Is there a demand that's already met? And if not, we want to come into a new market or a new city and offer the products that are best for the borrowers. And so that's been a success for us so far, and I think we'll continue to expand and grow our products as we grow across the country.
Great, thank you, Katherine. Kathleen?
Good morning. This is on. my name is Kathleen Tobin, and I am with Women's World Banking. Women's World Banking is a global nonprofit network of microfinance institutions. So we're comprised of 39 institutions in 27 countries. We're based here in New York, so we're a network, and my team actually works directly with institutions to develop products for their clients. And so we have seen, as we've been hearing, there has been an expansion of services over the last 5 years in particular, from credit to savings, insurance, and pension. And one thing that's been really kind of interesting for us is to have the chance to work with some of our network member institutions who have gone through the transformation from being credit only to offering, say, for example, savings for the very first time, and to work with them to develop products for poor women, savings products. And that's so much more complicated than it sounds, because an institution that has been offering credit for 30 years has a very specific type of relationship with its customers. It may have a very strong relationship, it may have a very positive relationship, but the relationship is really, we have the money, you want the money, so we'll tell you what the rules are. And for better or for worse, and there have been many, very positive things that have come out of that. But when it comes time to convince women now to give an institution their money, the dynamic changes completely. And so we have been helping our network member institutions develop savings products. It's one of the things we do. And to do that, really, taking a number of key approaches. One is ensuring that products are tailored to women, unique needs of women. We heard Scott say that women really are the focus, need to be the focus in microfinance, and we wholeheartedly agree. I'm with an organization focused on women, and they are, the financial managers in the household in most of the world. They are the ones who save. And they have needs that are different in many ways than men. Some of the bigger picture ones are that, in most of the world, a woman is much more likely to be unable to read, much less likely to have any familiarity with the bank. She's much more likely to be intimidated by the thought of even walking into a bank. She may have mobility constraints, so she, for cultural or religious reasons, may very rarely leave her neighborhood. And so our job is to help our institutions bring the products to her, communicate them on her terms in a way that makes her comfortable and shows her the benefit and the value in saving her money in an institution. We take a life cycle approach to product development at Women's World Banking, and that means that we kind of we try to help our network member institutions approach a woman's life cycle holistically and develop products that offer her the suite of financial services that she needs at any particular time. So for example, an adolescent girl may want to open a savings account for the first time because she wants to save for her education. A few years later, she may want to start a business and desire a loan. She gets married, she has children, she aspires to own a house. For any of those points in her life, she'll need savings, credit, and ideally insurance. She'll plan for old age, so we want to make sure that there's a way to offer her a pension, ideally that she'll be able to open at a young age. And as life goes on, she'll have emergency needs, her parents may become dependent on her. So the idea is to be able to think of her life cycle holistically and be able to make sure that there are products that she can access to help her, stabilize her family and build a strong economic base for herself. Our approach, Women's World Banking's approach, is to research, incubate, and scale. And so that means that on the research end, when we're working with an institution, we send teams into neighborhoods, we talk to women, we visit them, we visit their businesses, their homes, their farms, talk to them about their financial needs, understand the barriers that they may have to achieving those needs, and then we go back and we work with the institution to develop a product. We then pilot it. And one of the big things that we've learned, and that an area of focus for us right now is, it's not enough to develop a product and put it out there. You need to communicate it. The delivery channel needs to work, within her needs and her scope. She needs to be able to understand not just how it works, but why it's good for her and what's in it for her. And so we pilot not just the product, but also the full, the communication and the delivery as well. We adjust it as needed, and then, ideally we roll it out. one of the values of being in a network and having 39 institutions is that if we do find something that really works well in one region, we can then take it to others and adjust it regionally as necessary. But we're able to really pilot and incubate products in one area and then learn from that and kind of take it to other areas within our network.
Great, thank you, Kathleen. Before we move on, can we turn up the lights in the room? It's very dark. I want to make sure we can tell whether or not we're boring the audience to sleep or. Anyway, so while we're working on that, my takeaway from this, I think it sounds from all of you that in general, microfinance leaders, very well-intentioned, are at their core client-centric. There is an effort that's happening globally to try to introduce new products. Bob mentioned one of the big constraints being resources. And so a follow-up question I wanted to ask is, given the gamut of financial services that can be added, be it a new credit product, savings, a remittance product, introducing mobile technology as a device, there has to be some prioritization that happens, right? Because you can't do all these things at once. And so I'm curious from each of your perspectives, how do you think about, on the one hand, which product is more impactful, more needed from the client, versus the financial implications of rolling out that product? And a third element to that is, where do you seek a partner? Where have you seen MFIs needed to seek a partnership with another, be it a bank or another institution, versus taking on the onus of doing it themselves and all the pros and cons that come with that? So I'll throw that out. I don't know if there's anyone who wants to address that first. Start with.
I think it's a combination of things. There's first, from the client perspective, what's the greatest need, but then also the regulatory environment takes a role. Is the environment open to the need that we've identified, and then what kind of infrastructure is in place. And so, one of the kind of a trajectory that we've seen in many parts of the world is mobile banking. And so you could say that that's an enormous need and that we should bring it to everybody right away, because it means that the convenience and access and even confidentiality factors of savings for women, it brings all of those things to her instantaneously. However, at the end of the day, some of the key questions that we find ourselves asking are, what is the regulatory environment? That's a question that we're asking ourselves across the world as telecoms and banks jump into the space, and one of the questions that is coming to light in many places is who owns the customers. That's just kind of the tip of the iceberg. But so what is the regulatory environment for something safe like a mobile banking initiative? And then also, is the infrastructure in place? Do the networks work? If you're in Nigeria and you want to make a deposit, is it going to go through? And what kind of back-end work needs to be done, and what's the cost and the complexity for that? So I think we take a look at customer need, institutional capacity. So what are the strengths of an institution, and then what does the environment look like? And from there you kind of can prioritize in terms of what's which types of products rise to the top in terms of being able to meet the greatest need, the least complexity, with the least amount of time.
Kathleen, if I can jump in with maybe an unfair follow-up question, but just to be slightly more specific, I mean, can one generalize? Is it generally the case that an institution may find it just easier and more comfortable to add a new credit product versus do the work around developing savings, or is it just so situation dependent that one?
No, absolutely. And so I think it's easy to stick with for an institution to stay with what they know, and so if institutions have a core competency, for example, around credit, right? Offering a new product like savings takes an institutional overhaul in many ways. Culturally, internally, the institution needs to be realigned around potentially a new delivery system, new way of approach to customers, the need to build trust with clients, which they haven't had, in the past, and then also measuring and internal controls and from the data piece. And so that's an important point, is that how institutionally ready is an organization, and so what will it take, what can it take to kind of make that transition?
Got it. Great, thank you. We'll go next to Katherine. And Katherine, when Grameen started here in the U.S., sort of one type of product modeled off of the Grameen approach globally with the savings component. How, with some experience now in the U.S., how have you been thinking? What are the product ideas that you're seeing as having potential? And what are the challenges, again, around which ones have higher impact, how you prioritize your internal resources to roll them out, et cetera.
Yeah, you know, as I mentioned before, everything we do really comes from the borrower. So we do not take that top-down approach of you know, microfinance needs savings, so let's give everybody savings, or let's mandate savings, let's mandate credit. But everything that we've built and will continue to build really comes from the borrower's conversations and what they're asking of us. I think the U.S. is unique in that there are so many resources. I mean, you look at New York City alone, and you know, there's everything you could possibly need except for potentially microlending. So what we do is we try to get to know community organizations and get to know folks that are offering different types of products and steer our borrowers to places that are, you know, to organizations that are already offering specific products. One of the challenges we have, and one of the big differences between Grameen America and Grameen Bank, is that we're not a bank, so we can't hold savings deposits, which is what they do at the Grameen Bank in Bangladesh. In terms of regulations, as I'm sure you all know, it's a little difficult to become a bank in the United States after 2008. So we've been exploring it and thinking about it, and I think that's something that would really revolutionize how we run Grameen America here in the U.S. And if anybody has any ideas, I'm welcome. But you know, I think as we continue to grow, we're going to look at new products as the borrowers want them. We've had conversations right now in the field. All of our borrowers really operate on a cash-based system. So the businesses they run, food carts, at-home tailoring services, daycare centers, hair salons, it's really cash-based. But what they've asked us to look at is how can we start accepting plastic? So the obvious example would be talk to Square, talk to Intuit, talk to all of these solutions that have that accept cash or accept plastic on smartphones. So you know, that's something that we're looking at, and I think as we continue to scale, it's an easier product to build. But again, just to reiterate, everything that we do build really comes from the borrowers. Prepaid cards is another example that we've been looking at in terms of savings and distributing loans, and we're continuing to think through how that might work. And I think it'll evolve as our borrowers continue to define what they need and what they want as they grow with their businesses.
Great, thank you. Bob, it would be great to get your perspective.
Yeah, I mean, maybe because we do collaborate on some level where we're not just working with institutions as an institutional partner or client, but also on right down to the retail level. And that tends to be in a place where you have the footprint and the capacity to do that. I mean, in Bangladesh, we work with, say, BRAC. We've done a securitization for BRAC in Bangladesh of microloans in Dhaka and under Bangladeshi law, and AAA rated, and of an NGO. It was the first one, I think. Pardon? 2006. It was the first AAA rated microcredit securitization. Of an NGO's assets. It wasn't even waiting for commercialization of an institution. But in most countries, I would say, I'll give another example. In Mexico, we work with a microfinance institution. We have an insurance company there. It's the only place we do. And we created a micro-life policy because that's what was really to be tested. And it reached 1 million people. I mean, it was though, because no one wants to set up their own insurance company. I'm not sure why anybody would want to set up their own bank anymore. You know, I mean, that just seems a daunting, and you know, it comes with all the oxymoron of being able to be, you know, liberal and creative because you're incredibly regulated, and that's what's happening in some countries in the microfinance sector too. Suddenly, as they fall under the radar and appropriately need a regulatory framework to operate under, though, that can be a very heavy environment. So we created a microinsurance product. Of course, working with Grameen, I mean, their first office was right above our branch, I think, in Jackson Heights. I remember when kicking it off, and it really was quite sensible. They wanted to give access to their clients to savings products. And, you know, it wasn't likely to get a banking license or a credit union license that quickly. So it was to think about how can you partner with financial institutions that can provide that. And then how can you go further and do electronic payments, maybe to make it more efficient for you and for your clients. Many of the things we work on with microfinance institutions about bringing down their operating cost. So mobile banking may help provide that. It gives greater outreach, but it may also bring down cost for people. And then you link to that other services which institutions can provide. So I think that the collaboration by many institutions, some of which, if you look at Latin America, the majority of them are not NGOs anymore either. They've become, you know, one form or another of licensed deposit taker, and often, you know, some of them are privately owned or jointly owned across the region. And even there, the biggest ones are partners. These mics are going off.
There you go.
You heard me though, right? No, there you go.
Right, yeah, please, Scott.
Last year, BRAC launched something called Bcash, which is a mobile banking solution. I mean, everybody's looking to push to get onto this. Probably the biggest success story was M-Pesa in Kenya. We're pushing that out. I would say and I do think that has the potential to revolutionize. I mean, the idea of cashless banking that's financial inclusion, just pure and simple. I do think 2 points to make. One is certainly BRAC is more inclined to enter into partnerships with the private sector when it comes to tech solutions. That just makes sense. So Bcash there's an equity partner, a minority stake equity partner. And I think that has potential. I mean, if you just look at, I saw a statistic that, of course, makes sense when you think about it, but it still grabs you. There are more mobile phones in Africa than there are in the United States, despite the GDP of the U.S. being something 8 times that of all of Africa. And I traveled all over Africa myself, and I saw a lot of mobile phones. Mobile phones are everywhere. I didn't see any sort of, $100 crank-up laptops or some of the other, gee-whiz gadgets that sometimes get promoted as the next big thing to revolutionize the lives of the poor. But I saw a heck of a lot of mobile phones. So and I think the other thing is that, well, actually I forget what the other thing was. I said 2 things, didn't I?
We can come back.
I'll jump in if I remember what it was.
Sounds good. So no luck with the lights? Yeah?
Unfortunately, no.
Gotcha.
It's not a tech issue.
No worries. This is a note to self. It's a good place to come and sleep. But I know we're keeping you well engaged, so we'll keep moving. I wanted to follow up with a question about information flows, because whenever you're designing a product, you talked about the process of going out to the village and talking to people. People may tell you one thing and may do another, but you always want as much data as possible before you invest the time, the resources, the money, et cetera, to develop something. So I wanted to kind of hear from each of you what you're seeing, what role technology or other research approaches are playing in terms of helping you have confidence. You know there's a need for insurance, there's a need for a mobile solution, but how do you actually get confidence about the market size and sort of justifying the business case for investing in it? And then linked to that question is the output side of information, which is there's so much focus these days on impact metrics. And I'm curious from each of your perspectives how you're seeing organizations try to use, again, technology or other forms of research to capture information on the output side around impact. So I'll lob that out. Does anybody want to?
Okay.
Please.
2 thoughts on this. One is I did want to say, and I'll tie to this output and data, since I had spent most of my time working internationally for a long time before doing in the United States, I've also come to realize that what is an important asset for people is their financial identity, not just the financial product they get at any one moment. And that comes out of some work we're doing on new immigrants. But in many cases, what microfinance has also done is build people's credit history and build a history for people, build an identity, whether that's through most of the best ones are reported to credit bureaus. And then again, if they can open bank accounts or other financial services, you're really helping people to develop a financial identity that may well take them beyond your own services, and that would in many ways be a success. I think measurement of success has come later to the game, and partly it takes resources, it took time, it took data and a history, and I think there was such enthusiasm of growth and support that now there's a much greater emphasis also on measuring output. And that can have that could be a lot of things. That can be outreach. How comprehensive is your outreach? It can be gender. It can be urban, rural. It can be how have people's incomes grown, which is very hard to attribute just to one service, such as a banking service. It can be, some people use the success of the repayment rate to show that obviously the money was put to good use or able to be repaid. There are many matrices, but I think what is important is it's beginning to be a much more of a science than it was, and challenged between different types of skills, which are not those that most of us had, in terms of random control models and others. You'll read a lot about that. And then those who can argue about which random control models, thankfully, because there's even there the disputes within the outcome. But the transparency of information and data is just so useful, and because then a greater number of players can help come in with that. Some include those in the institutions doing marketing, Because if they don't know enough about their clients, they may not be fine-tuning or reaching the right clients. But then there's the others who also need to say, well, did that have the impact that I, as a funder or investor, was seeking? And so this has been an area, there's a lot of work, and I think that's an area where many more people who are not just looking at the credit side and bring new skills to the sector are becoming involved.
Great, thank you.
Yeah, when we started when Grameen started 4.5 years ago in the U.S., there were a lot of questions about what is the impact of microfinance. So we started at a unique time, and I think we recognized the challenge that microfinance was going to have going forward. So we implemented a monitoring and evaluation system, ultimately from day one. So we're starting to measure all of our borrowers based on their loan cycle. So every time somebody takes out a loan, they fill out another form. It's a pretty short questionnaire that we developed. And you know, to Bob's point, we're measuring not just things on income. So obviously we want to know what's the impact of that loan, but it's also questions around, are you hiring employees from one loan cycle to the next? You know, is your part-time Grameen America business becoming a full-time business? I think we're still struggling, and I think microfinance in general is struggling with how do you quantify the results of microfinance, because it's not just about how much more money do you make after one loan. I think there's a lot of other more qualitative answers that people want quantitative answers to. So it's been a challenge, but I think we as an organization recognize the importance of it, and we're pleased with the results. The other piece of the challenge is that people want results quickly. So we live in this environment where everybody's got an answer and everything's a number. But in microfinance, you know, our borrowers are living in New York City on $12,000 a year with 3 kids at home in Queens. That's a tough life. And so a $1,500 loan from one loan cycle to the next, it may give them an extra couple $100 or $1,000, but you know, people really want to see these tangible results. And as Professor Yunus has learned in Bangladesh, and I think lots of other micro lenders, change is not gonna happen in 12 months or 24 months. It's gonna take 5 years, 10 years, a generation even. So I think we're in a difficult place where we want to show results, but we also want people to recognize that it takes a long time. A lot of our other information that we get is qualitative from the field, so credit is a huge piece. We've stopped talking just about microlending, as we've kind of discussed on the panel, and more about what Grameen does in a holistic approach to poverty alleviation or financial inclusion. Credit is personally one of my favorite pieces in the United States, and I didn't really know a lot about credit before I joined Grameen, but you know, if you have no credit score, you're going to walk into a Verizon or an AT&T or a T-Mobile, and they're going to ask you for $500 for a deposit if you don't have a credit score. If you're living on $12,000 a year, that is a lot of, or even if you're not, that's a lot of money to put down just to get a cell phone. I mean, the same thing with Con Ed or looking for an apartment. So the credit piece to the Grameen program is really valuable, and again, a challenge to quantify, but we've got borrowers that are getting scores of 670, 690 after just 6 months of working with Grameen. So those are the things we're looking at and continuing to try to quantify and to, you know, talk about.
Great. No, if you don't mind, let us go about another 10 minutes, and then we'll certainly you can ask the first question when we go to Q&A.
That makes me nervous.
Let me go on to Kathleen. And Kathleen, I definitely want to hear your thoughts on how you're seeing the WW affiliates deal with the output side, the impact side. But I also am particularly interested on the input side. When you're going to MFIs and you're talking about a youth savings program or another type of new product, that MFI has scarce human resources. What are they doing to try to get information about their client base to have some assessment of the business case around launching that product?
I mean, we find that our MFIs, in many ways, they're closely connected to their clients through their agents. So many of our MFIs have an in-field sales force, say. So they'll come back to us and say, well, we think there's a case for youth savings, for example. Or we have a product out there, the competition is offering that product, so therefore it must be, this must be something that's really big. We can see it because our competitors are offering it, and everybody's got billboards up about youth savings. It must be very big. So we'll that's often a starting point, either the competition or what they're hearing through their own sales force. And then from there, we'll go in and actually do the research. And we'll ask about the competitive products, and we'll ask about, kind of broader sort of what do you really need, to find out what the overall needs are to develop a product. Another thing, though, that we've kind of been doing is now that savings has rolled out, and has been rolled out in some places for a couple of years with some of our network member institutions, what we're trying to do is track the use of accounts. So many women have opened accounts, but does that mean that they're actually using them? Like, how often are the transactions happening? You know, and what we're seeing in, you know, in more than one market is that having an account and using an account are very different. And so that has led us to kind of zero in to kind of figure out, you know, or actually I should say start asking the questions about what else can we be doing? Is the account not meeting her needs, or is there an information breakdown somewhere? And so we've been piloting ways to use technology to experiment with bringing more information to her about her account. So for example, we have one organization in India in which Bob is quite familiar with, in which the in-field sales agents have Apple iTouches. And those Apple iTouches deliver real-time information about accounts. That's step one. But what we've done is develop applications that are visual so that an in-field sales agent can very quickly show a woman the impact of missed deposits on her recurring account and how much interest she's losing in a visual way. And so trying to deliver concrete visual information to clients about their accounts and about the impact of their actions is kind of been one of my latest passions in terms of technology and how to use technology to measure use and impact, but also to sort of to drive it as well.
Interesting, interesting. Scott?
I think just to piggyback on this idea of the randomized evaluations that have been going on, what is the impact of microcredit? Our view is that microfinance, or microcredit especially, is and remains a vital tool for providing opportunity and freedom for the world's poor. It's a tool in the toolbox. It's not the only tool in the toolbox. And if you look at an evaluation and say, well, you know, this didn't solve poverty, that's kind of like saying, why didn't this hammer build this house? I think that, you know, if you look at the whole range of, as you said, the holistic range of activities that provide more opportunity for the poor, it ranges from healthcare, opportunities for education, supply chain support. And I think that, as you said, the use of evaluations to provide more information about, you know, how are people actually living their lives and what impact does this particular product have. I think that's important both for internal evaluation and for collaborative partnerships.
Great. So we've been talking so far almost solely about financial product evolution. I want to take it a step further because there's been a lot of excitement over the last few years about microfinance institutions as distribution partners because they have that last mile presence in the village or in a hard to reach area that can be very attractive to a consumer goods company. There have been examples of MFIs distributing energy products. Some MFIs have explored with health service delivery through their model. And so we'd love to hear from any or all of you sort of where, what you've seen, the experiments you've seen around going beyond financial service delivery, and the pros and cons of doing that, where you've seen it be successful and where not. Bob?
Because I see in many countries what others have done, few microfinance institutions have done, you know, who are not providing social services as well, say Grameen Bangladesh with multiple companies or BRAC, both quite unusual. Hello? Yeah, keep going? No, he's waving up there. Take yours. All right, there's something to do with my voice. Thank you. You know, I think when you put those, let's put those aside for a moment because they truly are unique institutions, right, that provide multi-services. They are, and the governments don't like when you say they are the state that doesn't, you know, within the state or the state that doesn't function. Yeah, I know, for both of their cases. We shouldn't say that in their home base. But in reality, most institutions don't do greatly at selling and promoting other products without diluting themselves quite a lot. And I think that's even true in financial services. I think in general, most banks that have gone too wide have come back narrower. I mean, ourselves or others, right? Don't do brokerage anymore, we don't think, or insurance. And you kind of say, well, it sounds like a supermarket was a great idea at one point, and then you realize your strengths weren't in all those things, or it was so hard to manage all of them that you might be better to collaborate with some of them, just as many of these institutions have, to bring specific products to bear or services for their members. So we see examples of it. I mean, sometimes, you know, you can monetize other things you're doing. We did something in Mongolia with carbon credits for, you know, ergs that look like igloos that, you know, saved energy. And that was a byproduct of financing housing effectively for people. But on the whole, you know, going into selling lanterns, smokeless stoves, mobiles, has not been tremendously successful or done at scale. What has happened is almost the opposite. Is many microfinance or other financial institutions are using third-party agents to actually reduce their own cost and to expand outreach for those mechanical needs of paying in and paying out and receiving cash, using kiosks or even using third parties. I mean, we have twice the number of branches in Mexico as we do in the United States, Citibank. You know, you probably wouldn't realize it, but twice the number at least. And yet we have 15,000 then third-party agents where you see Banamex aquí, which is Citibank in Mexico, greengrocers, railway stations, others, where you can go and receive and make payments. It's almost like a teller. And microfinance institutions, some of them try to use their agents to do that, but most have realized they don't really want to be in that part of the business. That's not where they want to put their capital. So they're using third parties in some cases to give that last mile of reach. So I think that it's still up for grabs, but you know, becoming a sales team of commercial products as a microfinance institution can also take you way off the mark.
Great. Other thoughts? Yeah.
I agree with what Bob has said, and we've seen a couple of things. One is when, you know, if the product in question, for example, a lantern or a cooking stove, is able to fit within sort of the routine and the structure of an existing MFI, then it, you know, seems to have a chance. For example, we have some MFIs who offer loans for, say, lanterns, and so the client doesn't actually ever, she receives the lantern right away and then begins paying back the loan. So it becomes, you know, a loan product, essentially. So you design a product around it. But what, you know, we're a network too, so I'll say that, you know, we're kind of agnostic when it comes to whether or not our institutional partners offer non-financial support. Some do, some don't, some do it better than others. But I do agree that when an institution moves away from its core, as in any business, you know, there's risk associated with that. One thing that we have seen, or one structure that we have seen that works very well, is if there's a partner organization that is specifically designed to offer the non-financial services. And one institution that comes to mind is called Ujjivan. It's based in Bangalore. It's one of the largest MFIs in India. And Ujjivan is focused on credit. They're a credit-only MFI. They stay focused on credit, but they launched a foundation specifically to offer the non-financial services. And they sit side by side. Parinam Foundation either offers directly or puts clients in touch with healthcare training, you know, English classes. They've also recently launched a very comprehensive financial education program that was designed together with Ujjivan. But what this partnership allows is for Ujjivan to stay focused on their core and for the NGO to handle the non-financial. And so the two are able to work together kind of symbiotically.
Katherine, thoughts?
Yeah, I mean, I think we sort of work in a similar way. So at Grameen America, we're really focused on, we know what we do, and we know what we do well. So it's micro-lending, savings, credit, and financial education. So again, and sort of as we talked about before, as things come up from borrowers, we'll certainly explore them, but we're more of a liaison with other organizations based in the United States. You know, we really pride ourselves on having built this trust in this community within the borrowers and these groups of 5 and the centers of 25 women. You know, the borrowers that we meet every single week trust us to be able to vet the right programs for them. So it's a vulnerable population that oftentimes doesn't have a lot of touch points with other organizations in the city. So while we offer the products that we offer and we're committed to that, you know, we also want to make sure that we're passing on the right organizations to our borrowers that make the most sense.
Gotcha. Scott,
and it's important to emphasize the microfinance group or the village organization in BRAC's case can be a gateway to other services. I mean, that's the touch point for the client. Whether those services come from BRAC or Grameen or from somebody else, you know, we're agnostic on that as well. That doesn't really matter. That's the definition of being client-centric. It's not important that BRAC provides it. It's important that the need is met and the opportunity is there. So I do think that maybe BRAC is an exception in the sense that, you know, we are kind of like the GE of the development world and kind of have managed to do everything and then some without getting completely lost. I don't know why that is, but whether BRAC provides it or somebody else provides it doesn't really matter, as long as it's, the point is the access is there, and it can easily come through the microfinance group.
Great, thank you. We're going a little bit over, but I wanted to ask one last question before we go to Q&A. I'd be remiss if I didn't ask the question about the role that different types of capital, different types of funding play in product innovation. And I want to throw out two opposite examples, hypothetical examples, just to sort of provoke the conversation. So one could say, for example, that an institution that is commercial, has lots of forms of commercial capital, and in spite of maybe being convinced that the launch of a new product, for example, could be profitable over time, there may be a concern that it distracts away from the core product. There may be a more short-term focus on maybe exiting in a few years, and could say, look, if you want to do that, do it through a foundation or find another philanthropic source. An opposite example could be a funder that comes to a nonprofit and says, I really care about this service, and I want to give you money to go do it. And then you may learn through discussions or through analysis that on the one hand, you'd love to have the funding, but on the other hand, it's not the right product, or it's maybe just not the right product in terms of the priority of what needs to happen. So I want to throw that as opposite examples of the role that different types of capital can play. I'd love to hear your perspectives on this dynamic and how you're seeing the organizations you work with manage that dynamic. Maybe we'll start with Scott and go down.
My personal observation is that the last scenario that you just described, it can be a problem, actually, because you end up chasing things that it's just, you end up operating on a project basis by responding to RFPs, and it's, what you're really trying to do is build an institution that lasts.
I guess I benefit of seeing both sides of the capital. I sit on the board of even our foundation, and I've worked in our business for many, many years. And I think there's all kinds of capital. I really think that there are institutions that have tapped, to say, the capital markets that are nonprofits that haven't changed their ownership structure. They're strong, well-managed institutions that should be able to do that in time. There's a need for philanthropic capital. That is really what underpinned all of the earliest stage work in the sector. It continues to be very supportive around taking chances, product innovation, outreach in a way that is not easy to fund any other way, and probably shouldn't be. So I always emphasize in this sector that all the best institutions, almost all of them began and continue in sometimes with side work that they do, even if they become sustainable in credit, with philanthropic capital. And then finally, yes, commercial capital has a role, but it is a role, as for any of you, as to why would you avail of it and how do you avail of it? And to serve what purpose of your institution as opposed to whatever provider of that finance there is. There are all kinds of investors, social and commercial. I think that it really is important that when one accesses that, the institution itself has the capacity and the management to determine how best to do it, and that is compatible with its own, its own plan and strategy and ethic, if that's a matter for consideration.
Great.
So I have a couple of different ways to answer the question. The first is Grameen America is a 501c3 nonprofit here in the United States. That being said, we feel we've taken sort of the best of philanthropy and the best of business and created this unique model. So we, all of our branches, the 8 branches we have right now, and as we continue to grow, are on track to be sustainable. So meaning the interest income we get from our loans is going to cover the operating expense of that branch, which is really unique here in the United States. It's certainly a battle that we've all talked about, and Professor Yunus has talked a lot about in terms of the for-profit versus the not-for-profit model in microlending. We've found that we found a good combination where we're on track to be sustainable, and it'll enable us to scale. So I think we're still waiting to see that happen, which will hopefully happen in the next few months. But it's a unique place to be in here in the U.S. The other piece is in terms of funders dangling capital in front of you and wanting to take it and run a program. We've been pretty good at staying true to what we want to do and the vision that we have here in the U.S. So it's happened, and it's always a challenge. But we really believe in what we're doing, and really stay true to the funders that are supporting the mission that we've got in place.
Kathleen?
Women's World Banking, we see a definite role and actually make use of both commercial and philanthropic capital. We have a fund that invest directly into our network member MFIs, and that's commercial capital. And then on the NGO side, where I am, we have a great reliance, and we look to philanthropic funding to drive very often innovation. And so the two are critical. Both are critical, I think, in the industry. And then one of the most important pieces, though, is just to ensure that the objectives are aligned between the funder and the fundee. And so whether it's length of time, whether it's pressure on returns, whether it's desired outcomes, you have an alignment. And and that's a balance that we strike, and that we try to strike. On the philanthropic side, of course there are funders that have certain focuses, and our response is often, okay, if we see a need and if we see an opportunity, then we'd certainly like to try to work with it, but we also have a strategy as an organization, and we need to make sure that we're staying with that strategy so that, to someone else's point here, that we're not just doing one-off products and projects. And so it's a balance, that we continually, I think, try to strike.
Can I just add
Please.
one more
Yeah.
quick thing? I think in the move towards savings, especially, don't forget the need for equity. Well, equity often fills the need that's there anyway. If you're taking people's money, that's a bit more complicated than giving it out in life in general. But you run into, obviously, regulatory hurdles and capital adequacy ratios. So, for instance, in West Africa, BRAC is partnering on an equity basis with Soros Economic Development Fund and Obenyar Networks in the move towards savings. Again, alignment is key. It's not always that. Then you're really in bed with somebody, and you've got to make sure that you have the same interests.
Wonderful, great. So we have about 7 minutes. We can take a few questions. We'll just please ask one question, and only one. And just please be clear, if you want it to be addressed by specific panelists, please indicate so. And if it's open to everyone, please also indicate that. We're going to start with the gentleman here.
Thank you very much.
Sure.
To answer it. I think the most obvious is based around the group lending model. So without wasting too much time, ultimately 5 people put themselves together and meet with one of our staff folks every single week. So while everybody's financially responsible for their own loan repayment, that group of 5, there's a lot of pressure and support that goes on within that group. So I think a lot of the successful outcomes come from this group lending model, and it's building networks and building communities, and all of a sudden these growing women entrepreneurs in Queens or in the Bronx or in Oakland, California see each other on the street and they recognize each other, and that's a new network for them. And those weekly meetings really encourage repayment and savings, and which all lead to increased credit, improved savings, constant repayment, and the other pieces of building a business.
Great. Next question. I saw that hand first. Yes.
I have a question for Katherine and subsequent to the rest of the panel. You mentioned partnerships, and I wanted to know kind of from the vantage point of what's in it for them. You mentioned Square as a partner, and I would love to see how you approach them to
Sure. So just to clarify, Square is not a current partner. just an example of somebody we might think about. And I think Bob's probably a good one to answer, mainly because we work so closely with Citibank as a really strong partner. We work with a community in the United States that's obviously unbanked. And I think it's challenging for banks to work with this community because there's a lot of trust that goes on with the model. So, it's the trust we have with our borrowers is something that partners can leverage to get products out to this set of borrowers, which is also why we're really sensitive to bringing on new products, because we want to make sure that the desire is there from the borrowers, not just from the partners. I think also we have the strong brand name that we've got, which comes from Bangladesh, is really helpful. And also, as we continue to scale and grow in the United States, we're on path to have a large number of borrowers that I think a lot of partners see as enticing.
I think it's interesting from the beginning. It was when as we began together as Grameen launched in Queens. It was an idea that one was I knew Grameen and their businesses all around the world. I just didn't know if it would work in the U.S. There was the precedents had not been good of those initiatives that had happened before and others, and so it really was one of this is something where the right people were behind it, and we should see if it does. The other was the need was clear. We're all in New York and Queens. You can't go blocks without hitting a bank branch of one form or another, or one brand or another. And yet, thousands of women that they're reaching not only didn't have access to credit, informal credit, because those products, the type of product that they're offered or not, aren't offered by banks, or probably wouldn't be designed the same way and not as effective. But they also didn't have even savings accounts or transaction accounts. So the idea that you could partner and find a way to, in some level, not only go deeper in a place where you're already present, and yet it's so clear outside your own doors you're not reaching the community. And then beyond this, could you really scale it? Could you find a platform to do this efficiently enough that it would be sustainable, commercially sustainable even? And in a way, I mean, in terms of just as Grameen will itself it will become sustainable, you call it commercially, but meaning it generates enough revenue to carry its cost base. I even think of that as the parallel products. That was a really important thing to see, could you do? Because it would demonstrate that you could then reach very large numbers of people with an appropriate level of philanthropic capital, but beyond that, a momentum that could really be built upon. So there was an alignment of this goal of seeing where we could get to. And I must give enormous credit. I mean, it seems to be getting there.
We take one last question. Yes, right there.
I have a question about, where does microfinance end, and when is a client too big for microfinance as to upgrade to a regular bank? And a second question is, so the field officer meets a client, we create a financial identity for him, we lend him, he gets bigger loans, but one day he comes and asks for a mortgage. Our mission is to improve the lives of our clients, but would it be mission driven to lend them money for a house? That's my question. Like, where does microfinance end, and when does a client upgrade into a regular bank?
So you broke the rules of our Q&A. No, it's fine. And just to add on to that, because I think it is interesting. No, that's fine. I think it's interesting because I think historically, for many MFIs, say my mission is to bring the client to the bank. This was maybe years, maybe an outdated view, but and I think there seems to be more recognition that actually being client-centric also means sort of being with that client over time. So I think that's maybe part of the question. So I'd love to hear.
Well, just BRAC created BRAC Bank for that reason. I mean, clients were graduating out of microfinance and into the small enterprise realm. That is important for poverty alleviation because it provides employment. I mean, if you have a small enterprise, we want to continue to support you. Just because you're not that poor anymore doesn't mean that you can't avail of the services.
Any other thoughts?
And I think it's much of what Katherine said earlier too. It's one of the things you're really going to give that client not only is the potential means of income generation and maximizing that in her business, for example, if the borrower's business, but also that credit score that will give them choice. And I think choice is a really important thing that we all have. Most of us have and take for granted. And some products, you'll be able to produce and serve the client with, and others you may be able to help, direct them to the best providers. But they'll be in a much stronger position to do that. And I think the example you gave on credit scores, everything from a mobile to a mortgage, is all very true. It's very empowering for someone to have a choice.
Yeah.
The one thing I'd add is that the most honest response I can give is that at Grameen America, it's been a learning process. So when we started 4.5 years ago, the maximum first time somebody can get with us is $1,500. And we thought to ourselves, when they reach $5,000, we're going to hand them off to the next MFI. And what we found is that borrowers don't want to go to the next MFI. They've built a relationship with us. They're comfortable with the program. And now we've got borrowers that are taking out, I think our biggest loan is about $9,000. And so I think that's the beauty and the excitement of working at Grameen, is that it's an evolving startup here in the United States. So there's lots of challenges and questions that we face every day, and at the moment we're not passing them on, mainly because they don't want to go to the next stop. They really like the program that they've got with Grameen.
Kathleen, anything else?
Yeah, just one last point on the where does microfinance end? It's an excellent question, and there are women who graduate, who come to the point where their businesses are large enough and they're ready to take loans that are larger than the group loan limits at our network member institutions. And what we found is that it can be very difficult to graduate from group to individual, partly because of the group support, and also partly because of the requirements needed for an individual loan. All of a sudden we get into requirements for collateral. She might have to have land, she might have to have bank statements. These are things that women don't have, even if they have successful businesses in many parts of the world. So what we're seeing now, and one of the initiatives that we have is to work with our institutions who have women in that position to develop a new methodology, we're calling it a women-focused individual lending that is based on, it's a cash flow, that it's a system that allows a loan officer to determine her ability to pay back a larger loan without the requirement of having to show collateral or bank statements or some of the more traditional things that are required for individual loans. And so we've developed a system that manages the risk appetite, or is able to maintain an appropriate level of risk for the institution, while also being able to appropriately show a woman's readiness to make the leap. But ideally, what we'd like to see is that women are able to grow their businesses, graduate from group to individual, and then continue, and eventually, be working with commercial banks if she wants to. Your question about a mortgage is absolutely, if we have the capability, we're going to definitely want to offer her or him a mortgage, because housing is a long-term asset that hopefully we'll only appreciate, and so that.
Great. I'm going to try to summarize and try to wrap up quickly what we heard. I started proposing these different definitions of client-centric. I think fortunately the one from cheesycorporatelingo.com we can wipe off. I think we all agree microfinance institutions are truly client-centric. I think there was this question of whether or not should you try to be everything to everyone. I think Bob made a good comment around yes, but be true to your competency. Your competencies around financial services, going beyond that can lead you astray. And also, that also involves having smart partnerships with funders where you're being very clear about what, being very clear about the outcomes you're trying to deliver against the capital you're raising for it. But then I think Scott made an interesting point that said, that doesn't mean you shouldn't forget about the other needs that people have. There may be a real health need, an education need, and so while your institution may not need to provide it, you can do work with other organizations, nonprofits, et cetera, to help meet that, and hopefully that ultimately gives you better borrowers, better clients over time. So please give a big round of applause to our panelists.